The half-year performance for Centrica has a number of different components to it. If I started with gross margin and EBITDA, both of those were fairly flat in the first half of 2018 versus 2017. However, operating cash flow fell 11%, primarily because we built working capital from the very cold weather that we saw here in the UK in the first quarter. That cold weather also translated into lower operating profit in our UK home business because our services business experienced an extraordinarily high number of call-outs and additional costs related to that weather, particularly back in March. And so in the Centrica Consumer division, we saw operating profit fall, primarily for those reasons, although we saw some lower operating profit in Ireland, as well as our major power plant there, Whitegate, was off for one of its scheduled outages. If I looked at Centrica Business, we also saw lower operating profit in that division, primarily driven from some legacy gas contracts that moved into a loss-making position in the first half this year, as well as in North American Business, where we continue to see compressed margins with respect to our retail power business. Most of that was offset actually in our E&P division, where we saw significantly higher production because of our rough gas field, which came on stream and was granted permission to produce at the beginning of this year. And we're also starting to see the effect of higher commodity prices, which rose in the first half of the year, also flowing through into our E&P division. And so the net of those three divisions meant that operating profit was down about 4%. However, at an earnings level, earnings were down about 20%, and that is really driven by the change in profit mix. The E&P business is taxed at a much higher rate than the customer-facing businesses, and therefore we saw our effective tax rate rise to 39%, something that we expect to continue to see in the second half of the year.